Hello everyone, it is 6:30, so we're going to go ahead and get started. Welcome to our webinar, Real Estate Investing, Buying for Cash Flow. We're really glad you're here tonight, and this is a very timely topic given the economic climate. You know, there's the lowest interest rates we've seen in our history, abundance of homes for sale, including foreclosures and REO property. So tonight we're going to cover a bunch of topics from how real estate compares to other assets, the benefits of investing in real estate, how to leverage your investment dollar, and then at the end of the webinar we'll be distributing one of our top investment picks in Austin that we publish weekly. And if you have any questions throughout the webinar, feel free to type them in the box on the right hand of your screen, and then at the end we'll be doing a Q&A. So, and also just to remind you, we're not attorneys or CPAs, so we cannot give you legal or tax advice, but everyone has a different circumstance, so please consult your attorney or CPA and get those things taken care of. So let's go ahead and get started. I'm your host, Katie Duggan, and I work with the absolute best team in Austin, Texas in real estate. We have two panelists who work in partnership on our team. Laura Duggan, the broker and owner of West Austin Properties. She's a third-generation native and has over 31 years of experience. And her partner, Patrick Birdsong, began working in real estate at a very early age, and he is now our listing and marketing partner and has been with our company for over 8 years. I am the buyer's agent, and I also work with our listings. So let's go ahead and get started. Patrick and Laura, let's talk about real estate and how it relates to household wealth, because most people have the majority of their wealth invested in their personal residence.
Well, that's exactly right. There are $6.3 trillion of household wealth in home equity. The experience that most people have is buying a residence and living there. 11.7% of the total wealth in America is in home equity, and 42% of family assets are real estate assets.
So sorry, I'm the one playing with the mouse here. It doesn't seem to want to click the way we want it to. So bear with us on that. But like Laura said, almost half of family assets are in real estate, whether it be your primary residence or investment properties. So it's an interesting statistic when you're looking at where people are putting their money.
We actually want to take a look at how real estate compares with other assets. And so let's do that quickly. Let's look at bonds and certificates of deposit and the yields for each of those over the last 10 years of time. You can see here in bonds and certificates of deposit, bonds yields in the last 10 years. In 2000, we had yields of 6.03, and boy, wouldn't we love to have that today. And in 2009, a yield of 3.26, so the average is like 4.46. And then CDs in 2006.59 yield, which was, now we're all wishing we could get some of that again.
Definitely.
And an average of 3.32%. So typically bonds and CDs have real low rates of return.
But they're real safe investments. So.
Exactly. And then mutual funds are another comparison, and we want to look at mutual funds. Often they underperform the market. You have an average of 3.6 10-year return. That was in years 2000 through 2010, and they're managed by someone else, so you have no input really. Dividends reinvested and are not paid to the investor.
So let's go over to stocks, finally stocks as an investment. If you look at the S&P 500, average return of 1.82% dividend, that's just a dividend. If we look at the yield or the appreciation, we've actually had a negative 30% depreciation over the last 10 years. And as you can see, that chart goes up and it goes down with the different cycles of our market. And all in all, from 2000 to 2010 with negative appreciation.
And Patrick, I think it would be helpful to compare the two side by side.
Well, let's look at real estate first here. So stocks, now we're on to real estate. Over a 10-year slide, 10-year period, the same 10-year period, I might add, we've had a 30% increase. So let me click back real quick. Stocks over 10 years, 30% slide. Real estate 10-year period, 30% increase. So if we take out that little hill in the middle there where we had that kind of a bubble, and this is a national chart here, you'll see that we had nice steady growth if we wouldn't have had the bubble of 30% increase.
And of course, in real estate, in Austin, we've had steady appreciation. It hasn't been just way up and then way down like in so many other places.
Yeah, it's such a good point because, again, this is a national chart. If you look at Austin, our line is much more straight across. We did have a little bump, but nothing like California or Florida.
So I jumped the gun, but can we go ahead and compare the two side by side?
Yeah, definitely.
Perfect.
So what we did was we took that 30% negative that the stock market and compared it right here to the 30% gain in real estate. And what we were doing was just measuring appreciation. Here we're actually adding in cash flow. So if you would cumulatively add the cash flow here of a $100,000 investment, you'd have more than doubled your money in the last 10 years as opposed to that 30% dip that the stock market took.
So that tells me that there are a lot of benefits to investing in real estate, and let's take a look at those.
Great. So the number one thing we're looking for here in investing in real estate is cash flow. And Laura, you want to walk us through this a little bit here?
Okay, so you have, of course, the rent is your income, and the great thing about investment property is your tenant pays for your mortgage generally, and you've got taxes that come out of your income. You've got insurance, management, maintenance, and mortgage. Let's talk about those.
Well, let me back you up one second. I want to talk about those renters. Right now, renters, they're 95% occupancy rate right now in Austin. That's huge. Average is typical like 85% occupancy. And on top of there being a high amount of renters, they're also paying more to rent.
Right, so rents are at a premium. Anytime you've got a real estate market like we have right now, you've got a premium in rents because people are coming out of owning a home into wanting to rent. So the expenses that come out are taxes, and the way taxes are figured here in Austin, you have tax rates that vary from 2.2% to about 3.1%. When you're looking at an investment property, you want to buy in an area where the tax rate is lower, and the way the taxes are figured, you take the value on January the 1st and you multiply that value by the tax rate, which is set in October, and those are what your taxes will be for the year. Then you also have insurance, and of course that's fire and casualty insurance, and an umbrella policy is a good thing to have if you own more than one property.
Yeah,
I know,
definitely.
Patrick, you just got one of those, didn't you?
Yeah, we have more than one investment property, and I talked to my insurance agent, and I'd heard about these umbrella policies, and the coverage was huge, and then the cost per year was so low I could not do it. So
Right.
it's such a great thing if you are buying multiple investment properties.
Good protection. And then there's the management costs. I know that some people are really hesitant to buy investment property because they just don't want to manage them. But management is really inexpensive, and when it goes into the expense side and you still have good cash flow, there's no reason not to have someone manage your property. Typically the cost is between 8 and 10% of the gross rent for the month, and then to rent the property, it's typically about 80% of the first month's rent. So the cost is really not that much, and
So let's just make that real simple. If you had $1,000 a month in rent, you're talking maybe about $800 up front to get the thing leased, and then $80 to $100 a month you pay to that management company to take care of all those little things that you don't want to do.
That's exactly right. And then you have maintenance cost, and there are some things that you can do to hedge those costs. One of those is to provide or to ask for and receive at closing a home service contract, which is like a home warranty that covers some of the repairs for the systems, the plumbing, the appliances, and that type thing. The service calls on those are typically around $60, and you can write into the lease that the tenant will actually pay for the service call, and that really does help out on the monthly maintenance costs.
Well, you just have the tenant call the home warranty company directly, and so that way you avoid the whole situation to begin with. That would be their first step. Second step would be call you. So.
Exactly.
And then if you had a management company, no phone calls.
Exactly. And then, of course, your mortgage, and that can vary in cost per month depending on whether you have a 15-year mortgage or a 30.
Well, and also right now, that's kind of why properties are cash flowing the way they are, is because interest rates are so low right now. And to take advantage of these interest rates would help your long-term cash flow.
One thing I forgot to mention is that, a lot of people like to manage their own property. They like to drive by and see what the property looks like, how things are going, really check in on the tenants themselves. And if you want to do that, that's great. One of the benefits of having a management company is the tenant screening, which is great because they do a very thorough credit check, background check. They check with the former landlord and actually check the day before somebody's to move into the property to see whether or not they're still employed. Mm-hmm. And but there are also some resources, I know, Patrick, that you were talking about the other day that are really great as an owner, because Patrick owns some rental property himself, that an owner can use to do those checks.
That's right. We make a lot of recommendations to our clients sometimes because renters are at a premium. You're getting them. It's easier to rent a property. You can do all this yourself. So the website we recommend is called eRenter. It's e-renter.com. You set yourself up as a landlord. It's a free thing to set up, and then you pay per application that you submit into their system. And basically what you do is you just take an application fee from whoever's applying to be your tenant and offset that cost.
Yeah, I think that's great. It is really easy right now to rent property. I mean, sometimes it's as easy as putting a sign in the yard, and within a couple of days you have your property rented. Even if you're going to do fix-up or clean-up or whatever, in between tenants, stick that sign in the yard and
yeah, I always recommend trying to put that into your lease agreement as well, that you can put that sign out the last 30 days of their agreement, or last 15 days. So we've talked about the renters, we've talked about your expenses. Now the cash flow at the end here, the fun stuff.
Exactly. And of course, cash flow is the primary reason to invest in rental property.
One thing I left out on expenses too, is, and that we don't like to see on this expense chart, is homeowners dues.
Oh, that's right.
It's good to get into a neighborhood with homeowners associations, typically with a lower cost homeowners association, because those can get out of hand. And the other thing is,
especially in condos.
Definitely
some of the condos downtown, the HOA fees are so high that it doesn't even provide you with a cash flow.
Yeah, it'll take all your cash flow away.
Right.
You're right, Katie.
So it's important to know that even if you do want to rent it out, that you have to factor in that HOA, which can be even up to $600.
Well, and not only just the homeowners association dues, but sometimes the properties even have special assessments that you have to think about as well. So if you do buy a rental property and it does have a homeowners association, you want to make sure that you can review the homeowners association rules and regulations. I know there's some that won't even allow an investor to come in and purchase.
Or some that have limits on the percentage of the building that can be rented out. I know we have a problem with that at the 360 because they can only have a few units rented out.
My building's the same way. They're putting a cap on it this next year. So I completely agree. When we talk about investing in real estate, our goal property is 3-bedroom, 2-bath, ranch-style home. That is the typical home that somebody would buy. It would be the typical home somebody would rent too, and they cash flow very well.
And you actually want to buy in the middle of the value, so you don't want to buy the lowest one in the neighborhood or the highest one in the neighborhood, but one that's right in the middle and has a nice-looking property on either side. So those are some of the things that we look for. So besides cash flow, which is the primary reason to invest in residential real estate, We also look at appreciation too, even though we consider that appreciation should only be considered as a bonus. Yeah, for sure. Because, you know, I've been around a long time. I've seen these cycles go in and out. And for the longest time, when real estate agents talk to potential investors about investing in real estate, one of the key things they always added into the equation was appreciation. And I think that if properties cash flow without appreciation, you should just be looking at that as a bonus, really, don't you?
Yeah, you just don't even consider it until you go to sell, and that's when
That's like a monthly salary, whereas the appreciation is just a bonus to you and your salary. It's like a Christmas bonus.
That's exactly right. But if you do look at it in relation to the whole project, you know, in the past we've had 5%. Pretty much 5% appreciation, so that's a bonus over the last 40 years to get that kind of return.
That's 5% a year, despite the S&P in the 80s, and most recently the mortgage fell out. We still had that 5% appreciation over the last 40 years on average.
You know, and there are also people who are really talented at building the equity and building appreciation by making improvements to the property. I know in the past, Brad and I bought things, and we've added a privacy fence. I know one year we bought some duplexes, and it was actually pretty hard to lease at that time. We got a great deal on the duplexes, but it was hard to get tenants. So I thought, gee, what can I do to actually get tenants in these units? And I hate to date myself, but back in the day, the big hot thing was the microwave. So we put microwaves in all our units and leased them right off. So microwaves, and the other big one was security systems. That was kind of a novel thing back then. And all of those things just help the property appreciate.
And right now, the easiest thing, because of the Home Depots of the world, are fixtures. How cheap are fixtures now to put new lighting in, to put new wall plates in? It's such a quick, easy fix to a property that really makes it pop immediately.
Right. I mean, even flooring and paint, and we have a great team of people that can do all of those things for our investors.
Definitely.
So home appreciation is less volatile than the stock market.
So we just showed you here the 5% over the last 40 years. Let's take a look at that chart and try to figure out where this is going to. So you can see that obvious bubble in the national statistics here. Huge, huge rise, and then huge drop. But right now we dropped right back to where we were going on our normal path if we wouldn't have had that crazy amount of appreciation and growth. So that's a really great chart to see where, despite normal circumstances, it's just been a continual ride up.
Remember, it's a bonus.
And another real benefit to investing in real estate, you know, over other types of investments is, of course, leverage.
Leverage is a beautiful thing, and it's very specific to real estate. So our example here, $1,000 in real estate versus $1,000 anywhere else. Right, it's pretty much even money if you're not leveraging. But if you leverage, so 20% down, you're creating leverage in buying property. That's something you can't do anywhere else. You're using other people's money to earn returns. Again, like I said, it's largely unique to real estate.
Yeah, because it gives you so much more for your investment dollar, absolutely.
And you can still do it very, very conservatively. You don't have to over leverage like we saw in the past where people were buying properties for 100% down, 100% leverage.
That's right. In fact, you can't even do that anymore, and for good reason, because it shouldn't have ever happened to begin with. It's a good way to make that investment dollar grow.
Definitely.
Right, and then not only that, but of course there's tons of tax benefits because there's lots of things you can deduct, like property taxes, and then things you can appreciate, like property improvements.
Depreciate.
Yeah, depreciate.
I mean, we appreciate depreciation.
I appreciate the depreciation as well. And then also you can defer like capital gains taxes through 1031 exchange. So now on these, can you go into detail?
Yeah, absolutely. Investors can deduct all of the expenses related to owning a property. So that would be the advertising expenses, cleaning and maintenance, commissions, et cetera, insurance, legal fees, transportation. If you're going to go and visit the property, you can deduct that expense. Long distance travel, any losses that you have, professional services, repairs, and utilities.
And these change all the time too, so always consult your CPA on what you can deduct. And then also a good management company will help you keep track of this as well.
That's
so
right.
Make sure that they're helping you with that.
You should get a monthly report from your from the company that manages the property. And Patrick makes a really good point. I make it a point to sit down with my CPA every November following an election, if it's an election year, and just see what the implication of new laws might be or what I can take advantage of before the end of the year. And by doing it in November, you still have a month or 6 weeks to make some adjustments. So that does make good sense. And then there are also improvements that can be depreciated. So if you, say, add on a deck or a porch, or you pour a new patio, or you add a sprinkler system, or...
And all things improving the value of your property too.
Exactly. But these are things that have to be depreciated over time, and that rate can change as well. But that's another really good reason.
And I know for some, depreciation can kind of sound complicated, especially when you call it appreciation. So, Patrick, can you kind of simplify that
Sure.
for the group?
So if you purchase a property that's worth $100,000, $85,000 of that is attributed to the improvement or the actual house that sits on the land. So that other $15,000 we'll call the land value. So we're just talking, you can only depreciate the improvement on the property.
All right, so what makes up the property value is the improvement value, which is the building, and the land value.
And you also get taxed differently on both those too. So when you're looking at your tax valuations, look at the land value and the house value. You can protest those separately as well.
That's a good point.
So $85,000 worth of improvement on that property. So that's our basis. We're going to calculate the first year's depreciation based on what month you purchased it. So you're going to prorate. So say you bought it in June, you're going to cut that in half, or whatever your yearly depreciation would be. So right down the middle. So right now, you can, in every year after that, you can depreciate for 27.5 years. The IRS deduction rate right now is 3.6%. Hopefully that'll stay the same. And that would leave you with ability to deduct $3,090 a year.
Right, and so if you bought the property in June, you're going to get to deduct half the amount for the year that you bought the property.
Exactly, yeah.
All right, well, let's talk about leveraging real estate in your retirement then.
Yeah, so we've talked about deducting expenses. We've talked about depreciating expenses. Now let's talk about deferring those taxes. So what we talked about is the average American has about $25,000 in savings. You could put that into a self-directed IRA. Katie mentioned a 1031 exchange. Lots of ways that you can take this savings that you have for retirement and buy real estate for it. Now, this is definitely a little bit more complicated and something that you have to sit down with a CPA, and there's only a few companies that will let you manage your own IRA. So be careful setting those up, and there's lots of rules, and this is something that you don't want to have any gray areas with.
Well, yeah,
really
you want to
specific.
seek the advice of an expert on that,
Yeah.
but it can be done, and rather than having that money invested just in a mutual fund or something like that, you can use it to buy real estate, and we would encourage that.
And instead of you benefiting from the purchase of the property, your IRA would benefit.
That's exactly right.
To be tax deferred.
Exactly, exactly.
And again, if you have any questions on any of the terms we're going over or the content, please feel free to ask questions on the right side of your screen, and we'll be happy to answer those. All right, so let's start talking about real estate investing myths and reality.
Gosh, there's so many myths about real estate investing, and probably my favorite one is that real estate investing is only for the wealthy. That's just simply not true. You don't have to be rich to invest in real estate, and there's some numbers that prove that out. 2009 median income for investors was $87,200. Definitely not a rich man.
Not rich at all.
Sorry. And 43% made less than 75,000. 63% made less than 100,000. And you know, even Patrick, right out of college, was buying real estate as an investment. So I would encourage you to figure out a way to do it, because it's really a great way to build wealth, even for a young person.
Definitely. So let's look at that in terms of a chart. So you can see these dots represent investors. 6 out of 10 of those dots lie below that $100,000 line. So it kind of puts it in perspective.
You know, another thing as a parent, if you have a young adult that you can help buy a property, that is a real estate investment in itself too, and you're actually building the confidence to own property while still giving a little bit of help. And I just think it's a great way to start someone out.
Yeah, I mean, not only that, but it could pay for their college.
Yeah, my father and I bought a property when I was in high school, and we were able to sell it and pay for my first 2 years of college, which was such a great thing. It taught me how to manage a construction crew and get it all ready, get it leased, get a tenant in there, all those aspects that, you know, do have a little bit of a learning curve.
And you may have a college-bound student who, rather than putting them in a dorm, you could...
Or rent for 4 years.
Right.
I wish it was 4 months.
Yeah, you could put them into a property and with a roommate and start building that cycle of investing.
So this is just a quick portrait. This slide's just a quick portrait of what the average investor looks like. My favorite statistic is that 78% of investors are married couples. It's not just for the loose single guys or girls out there to invest in real estate. And then half of investors are under the age of 45. You don't even have to be able to be elected president to invest in real estate.
So another myth is that real estate is too expensive. And nationally, the median investment property price in 2009 was $105,000. There are so many ways to invest in real estate, including leveraging and self-directed IRAs. And with short sales and foreclosures and motivated sellers, I see more motivated sellers now than I've ever seen in my real estate career for a lot of different reasons. Either they're wanting to reduce their risk of owning a property, or maybe they've had a job loss or have to move for some reason out of town, or they've had a lifestyle change, maybe a new baby or whatever. But we've got lots of motivated sellers now.
Yeah, definitely. And I want to go back real quick to that $105,000 number. We're going to show you some numbers that are much better than that on buying real estate in Austin. So like Laura said, and also to relate to Austin, these short sales and REOs, about 18% of sales in Austin right now are short sales or foreclosure sales. That's 1 in 5, almost 1 in 5 properties that sell are short sale or foreclosure. So there's huge opportunity to get into real estate at a cheap price. And if you don't mind, Laura, can you kind of, just so we know, just define these two terms for us?
Right, a short sale. A lot of people still don't really understand what a short sale is. A short sale is when a seller owes more on the property than the actual value of the property. So say the seller owes $100,000 on a property, but he can only sell it for $80,000. He is short $20,000. And that shortage is something that the seller asks the bank to absorb and take a lower value on the house. Now, to qualify for a short sale, you have to demonstrate some pretty significant hardship, a job loss, maybe a terminal illness in the family, an inability to work, and have no assets that could be used to make up that short difference. Now, REO property is a property that's already owned by a bank or a lending institution, and those are typically the ones that you either see at auction or listed for sale with an asset manager.
And typically with these auction properties, they are already foreclosed on. The banks try to sell them through normal means, and they just can't get rid of them. So they liquidate them basically at auction. And I just want to issue a little bit of caution with auctions. They can be very squirmy. They're designed for the price to be pumped up as quickly as possible. So when you do go to an auction, know your price.
Don't just assume you're getting a deal.
Yeah, don't assume you're getting a deal.
Wait it out. Yeah.
Great point. And you can also, the one thing too about an auction is you can finance at an auction too. You can leverage a property. It's not just for cash buyers. So it can be a good strategy. You just know the property you're going after, know the price you're willing to spend, and be willing to walk away.
You know, Patrick, I'd like to remind everybody that we do extensive market statistical reports every month, and we post them on our website. Sometimes people think just because it's a foreclosure or just because it's a short sale, it's a good deal, and that is not always the truth. So be sure that you do know your numbers, and that's really important. Katie made a great point. I mean, we've actually seen people pay way more than a property is worth at auction.
Yeah, the last auction I attended, I evaluated 7 properties that were up for auction. Only 3 of them were good deals. The other 4 were priced well, and they probably paid market price for 3 of them. One, I have no idea why they paid what they paid for. It was a complete rip-off, and I feel really bad for the people who ended up buying it. So just be cautious when you're going in there. It's always good to know exactly what you're buying.
Okay, so another myth we have is real estate investments are mostly resort properties.
When in fact, only 5% of these are resort properties. In fact, most of the investments are either in suburban or rural areas or in small towns,
Yeah.
so that are surrounding larger towns. Like there's so many great investment opportunities in Buda, in Kyle, in Pflugerville, in Cedar Park, in Leander.
And right here in Austin.
That's exactly
Okay, but before we look at those specific properties in our market and show you how we evaluated them, let's take a look for a minute at how you can optimize your investment with leverage. Patrick, show us the 5x5 model.
Okay, this is really a simple concept. It's trying to show how in the long term you can really grow your assets with real estate. So if you took that $25,000, which we're saying is the average American savings, and you leveraged it and you bought a $100,000 property, in 30 years, so we're talking long term here, 30 years, you're looking at $2.1 million in equity. And that's not counting the monthly cash flow that we consider the only real reason to invest in a property. So we'll look at it a little more in detail here. So the reason it's called the 5x5 is we're looking, 5 different steps here. The first year 5, you'll build about $52,000 in equity. That's just with paying down your mortgage and building equity within that property. You can re-leverage that money, so either you could take the $52,000 at the sale and buy a bigger property, or buy multiple properties worth the $52,000, so about $210,000 worth of property.
Yeah, and exactly. So you take that and either buy one, or at that point you might buy 2.
Yeah. And then year 10, you do the same thing. You pull that $110,000, and we're doing simple math here. $52,000 doubles to $110,000, and you can re-leverage that at 25% down. If you take all $110,000 of that and put it down, you can buy, like Laura said, $443,000 property, or multiple properties to equal that 443.
Yeah.
So, and then we'll keep going here. You can see at 15, it goes up to 932. Your 2019, 1,000,009, and then 25.
4 million.
So
just look at that number.
We'll put this on this chart here real quick to kind of show you how that stair steps up. If you were to compare that to a mutual fund, where you took that original $25,000 and put it in a mutual fund and let it sit for 30 years, because that's basically what you're doing here. You're not putting more money into the property, just that $25,000, and reinvesting that over and over again. So it's a huge difference in the return.
We're not kidding.
So now I bet y'all are antsy because I'm antsy. Let's now that we've shown you all the possibilities, let's look at some real life opportunities right here in Austin, Texas.
So right before we get to that, we want to define what cap rate is. And the reason we're going to do this is because this is the best apples to apples comparison of properties. It's so hard to walk up to all these different properties and compare them. So the best way to do it is to use a cap rate. So cap rate is real basic. It's you take the gross rent minus the gross expenses. So you're basically taking your annual cash flow for the year, and you're dividing it by the purchase costs that you paid for the price, the property, the repairs, and the closing costs.
All right, so you've got your annual cash flow, which is your gross rent minus your gross expenses, and you divide that by the purchase cost, which is the purchase price. Say it's $80,000, and maybe you've got $5,000 of repairs, and then another $5,000 of closing costs, maybe $90,000 total.
Exactly.
So what would be a successful cap rate?
So cap rate, the term came from commercial real estate, and a good commercial performing real estate product is between 6 to 8%. We're going to show you a lot better cap rates than that in residential real estate here.
Because what we want to do is at least have double digits. I mean, that's what we're looking for.
But
Steals
again,
and steals.
yeah, 6 to 8% is really great return on your money. So these first homes, we're going to look at 2 slides of homes that have already sold. These things are already done. Somebody else got a great deal on these things, but we want to show you that these deals exist.
And by the way, we are going to post this webinar on our website next week. And so if there are slides that you want to see in more detail or take a little bit longer time looking at them, don't worry, you'll have your chance to do that. And of course, you can always get the same information from us in more detail if you want that as well.
Definitely. So I took the 3 properties right here from the same zip code, that 78744. These are all 3-bedroom, 2-bath, 2-car garage homes, basic houses, 900 square feet to about 1,500 square feet. I can't almost get past the price per square foot of $52 a square foot is the highest one we see here. Highest sold price on this list is $65. So my biggest thing here that I like is that these properties were not flying off the shelves. These are properties that sit on the market. This isn't like a gold rush where you had to be the first one on it right when it comes on the market. That first house took 200 days to sell. Originally asking $80,000, and somebody paid $50,000 for it. And it needed little to no repairs there.
Was that a short sale or a
that was a foreclosure.
Okay.
The middle one here in South Highlands was a short sale. And the last one here needed some sheetrocking and things. Basically, it was abandoned by a builder and was foreclosed on.
Okay, so builder started it, couldn't finish it, came upon hard times, and it really needed very little from what you said.
Definitely,
right?
Yeah, not a lot at all. And as you can see, it was started in 2007. You're basically starting with a brand new house there.
Yeah, I mean, the curb appeal is beautiful.
So we're going to look at what kind of returns you can get here. So down at the bottom, you'll see first the rents you can get. $950 up to about $1,100 for that brand new property.
Okay, now these rents, we didn't just guess at what they might rent for. We actually went into the neighborhood and pulled comparable rents for comparable properties.
Well, a lot of times these are right on the same street, yeah.
That recently have leased,
So you can see what kind of monthly cash flow we're looking at here. At the low end, $275 a month cash flow, up to $435 on that last property, and cap rates way above that 6 to 8%. We're talking, and basically cap rate too. You can consider if you bought the property for 100% down, that's going to be your return on your money. If you're looking at 20% down, your cash on cash return will be anywhere from 32% to 40%. So if you compare that kind of cash on cash return to, like, say, the stock market, and again, this isn't factoring in appreciation. You're beating every last one of the different performing products in the stock market. Okay, so we got the next one here. Here's some more fun ones. These needed more work, and you can see all 4 of these are in different zip codes. You got 4-bedroom, 3-bedroom, 5-bedroom, built in different years. The big thing here is this price per square foot. That first one at $35 a square foot. I think the cost to build is real low right now, but it's still up $75 to $80 a square foot just to start our home.
And by the way, those costs to build are going up.
They are going up
considerably. You can expect to see next year the cost of sheetrock and lumber to go up as oil prices go up. Prices for construction materials are also increasing, and from shingles to all the different building materials.
So another thing too, again, I like to point out is the days on market. At the very least, this was on almost 2 months, that last one, up to almost a whole 285 days on the market. So they had to sit there for a while before somebody got the price down to where the banks will sell it.
And you can see how Patrick adjusted at the bottom for adding in the repairs.
I wanted these numbers to be realistic because, you know, when you look at a house selling for $38,000 in Austin, we're not talking on the outskirts, we're talking in Austin proper. You got to factor in what the repair cost would be. So that one would be about $7,000. It would have been about a $45,000 investment.
And they actually record what the repairs are in the listing,
Definitely.
so we know exactly what they are.
Mm-hmm.
So you can look here at what the rents would be, anywhere from $1,000 to $1,250, and that one on the far end that's getting to $1,250 kind of looks like a little bit of a shack, but it's in such a good zip code.
Is it pink?
It almost looks pink, doesn't it? And then your monthly cash flow of anywhere from $320 up to about $560 a month that you're pulling home, anywhere from 10%, 11% cap rate up to 18%. And then, you know, if you leveraged at 20% down, that last one, you're getting $64 or 64% return on your money.
Gosh, my very first house that I ever bought, my house payment was less than $560, and this is what the cash flow is on that one. Wow.
That's how much money it's going to be making you every month.
That's crazy.
And you're getting $1,250 a month. Also has to do with that it's a 5-bedroom. So.
Right, I agree with that. More bedrooms, more people.
Okay, so I actually have properties that you can actually buy. So this first one here,
Without your checkbooks.
3-bedroom, 2-bath, 2-car garage, East Austin, minimum repairs necessary. They're asking $70. That's about almost $50 a square foot. Let's see, potential lease of about $1,100, cash flow of $270. Really, you can see these numbers are great, but I want to go back where you can see these others that have sold that started out at $70. There's 3 of them that started out in the $70s. So that $70,000 is already a deal, but I'm sure you can buy it for less because that is a foreclosure property. You just have to bid correctly on these things.
Right, and so it says potential lease $1,100 a month, but we're fairly confident that that is a good lease amount.
And I'm very conservative in these numbers. I don't like to overshoot and really get people's hopes up. I like to get the bottom lowest number, and you know, if you could rent it for a little bit more, then it's just all that much more money you take home.
Right, and that cap rate's just under the double digit, so with a better buy on that.
Yep. So this next one is actually a duplex, and I picked this one because it's in the 78745 zip code. That's Cherry Creek, so that's a great area to own property in, and you know, a lot of people live in that neighborhood right down the street. There's duplexes mixed in with a single family, so
right.
it's really nice.
And I love duplexes because then you've got your you've got 2 different tenants who are working to help you make that payment, so your risk is minimized because you've got 2 there. And I can tell you, Brad and I bought some duplexes way back when, and we actually had a tenant that was with us for over 15 years. She actually paid for that entire duplex, and she was a dreamboat tenant.
And the other side was just cash flow.
Yeah, absolutely. She paid her rent on time, and it was fantastic. Yeah, she was great.
This one's also REO. It's been on the market 175 days. So it's seasoned, so to speak.
Right.
This one's a little bit more expensive again because you're getting a lot more rent because of the 2 sides. $145,000 is their asking price, again, not selling price. This is just what they're asking. Lease around $1,550 a month, looking at about $350 a month in cash flow. And again, that's not your sold price. So cash flow only goes up the more aggressive you bid on these things. So in this one, cash on cash return is a lot higher at almost 15%. Okay, so this last one here, we only picked 3. We didn't want to overwhelm you here. Is also in East Austin, a great little neighborhood, a real small neighborhood, right next to a magnet school over there, Magnet High School. So this one does need a little bit more repairs, not much though, only $2,000 to $3,000 worth of work, besides just your normal stuff like paint. $75,000, which is only $57 a square foot. Cash flow at that price of $322 a month, and you can see both your cash on cash and your cap rate are above 10%, so in the double digits. So really great properties, and again, directly across the street from a high school. That's investors' dream right there, because their kids, people who have kids in middle school and high school, they're long term. They're not going anywhere if their kids are going to school across the street.
I think that's especially true with elementary schools. I mean, the properties that I've owned that have been close to elementary schools have always really held their values, and I've never had trouble leasing them, and you've got the playground, etc., that you can use some of the amenities of the school. Kids can walk, etc.
Definitely.
Okay, so if you're interested in any of these homes or in getting our investor picks of the week, feel free to call us. Our phone number is 512-345-1252, or you can email all of us at homes@westaustin.com. And feel free to visit our website at www.westaustin.com. There you can download our monthly market report, as well as see other featured properties we have. And just in case you missed this or you missed our last month's webinar, they will all be posted on this website. And our next webinar, to keep your eye out for, will be selling in a buyer's market. We will be having a webinar the second Wednesday of every month, so stay tuned.
So that's going to be a really great webinar, because we're going to talk to sellers frankly about what they need to do to get their property sold, and that's going to be important.
So right now there's about 20% more homes on the market than there were last year, and about 40% less selling per month. So you got a huge gap in what's actually selling. Only about 12% of homes actually sell per month. So you have to be competitive, especially when you're competing with these foreclosure properties and these short sale situations.
Right now you want to get the deal on the buy side as well. So we want to help you, get out of your home and move on up and take advantage of those deals.
Definitely, especially the interest rates.
Yeah, and we all know those are not going to stay low forever. In fact, our government is keeping them artificially low, and that's not going to last forever. In fact, we've actually seen them tick up over the last couple of weeks. Yeah, so it's opportunity time for sure.
And we just want to review something real quick, too, if we do represent you in buying and selling investment property. Kate, you want to go over these tenants real quick?
Yeah. The first 1 through 4.
Yeah.
We always do what is best for you, and we'll never close you on a bad deal. And that's really important. I mean, that's been our motto in everything we do. Real estate should be purchased for cash flow only. Appreciation is a bonus. Remember that, a bonus. Real estate investing is a non-emotional event. We always do the math. This is not your home. This is a money-making thing for you, so take the emotions out of it. And number 4, you as an investor play a vital role in the real estate market and deserve to be treated accordingly.
I firmly believe in that last one. This market's not going to turn around unless somebody comes and buys these assets off the market and really gets them clear so that we can get back to a normal market. And until the short sale and foreclosures come off the market, we're not going to really see much appreciation.
Now, this can be a 3-year event, of which we're probably into the end of the second year, or it can be a 10-year event. So we'll just see which it is.
Definitely.
Right. Okay. Well, thank you all so much for joining us for our webinar. I hope you learned a lot. And if you have any questions, again, we're going to stay around for a few minutes to answer those questions. I know we got a few in, so we're going to go ahead and answer those. Our first one, are y'all ready?
Yeah.
Okay, perfect. This kind of goes over what we talked about, but should you invest in something you would live in?
Well, I do have a client in that situation right now. They're actually going to buy a duplex, and they're going to live in one side, and they're going to rent the other. And the best thing that they're going to do is that they're going to hire a management company, and they're not going to tell the neighbor who's their tenant that they're the landlord.
That's a great idea. I wish somebody told me that back when.
I'd be nervous.
Yeah, so it's a great way to buy a property and buy a home, but also buy an investment property and pay for that home through that investment. Because you really, these days, you don't want a roommate. This is like fixing that roommate situation, having your roommate pay for your mortgage, but not living with you.
But on the other hand, we talked about this a little earlier too. You may have a property right now that you live in as your personal residence that you want to convert into investment property. Get that property leased out, keep it, and then buy another property. So one of the things I've always been disappointed in is every property that I've ever sold. Looking back over the years, I wish I'd kept everything I'd ever bought. Man, especially that great duplex in Travis Heights that was on the creek. Beautiful deck off the back.
Nice.
Well, and if you own something and it's been on the market for, you know, a few months and you're just getting kind of weary, go ahead, lease it out. When you put it back on the market, your days on market go back down to 0. Put it back in a time when things are selling.
Sure, that's right. The other thing, I don't know if the question was going for too, is should you live in the property you invest in? If you're dealing with like a self-directed IRA or 1031 exchange,
Oh no.
you can't invest in your primary residence. It has to be investment property. So I don't know if that was
You can drive by it and see it. And for most of your
you can wave at your
portfolio,
retirement
you
fund.
cannot. Yeah. Okay, next question. What areas in Austin are the best investment areas?
Well, that's a great question. We have our market report that comes out once a month on page 10. Page 10 is that investment report. It outlines how many foreclosures there were in the market, how many short sales, and how that compares to the year before. It also outlines those top performing area zip codes.
Yeah.
So,
I mean, so you see days on market, you see lists to sell.
Yep. And right here you'll see 78744 is a great zip code to invest in. And then I got here 78721 I know is a strong one. And then some of these were kind of anomalies. The 78753 doesn't have many properties that sell at low prices, and somebody got in there and got a great deal.
There are virtually good buys in every zip code, though. I mean, there are
Definitely.
some good buys in every single zip code.
It's just how you structure it, how you leverage it,
and how much you want to put into it.
Yep.
So we're scanning every zip code and area for y'all.
Yeah, definitely.
Which is important. Okay, next question. And please feel free to write any questions y'all have. These are some great questions. Can you invest in downtown condos and get cash return each month?
I would say yes and no. The point we made earlier that Katie brought up was that the HOA dues can really zap all your cash flow. Now, I do know a property manager who's managed about 15 cash flowing properties. It just depends on how much you're willing to put in. So if you were a cash buyer, you could make some of these condos work. But like you said, if you're paying somewhere between, the average HOA due is about $30 a square foot. So if you owned a 1,000 square foot condo, that's $300 a month. And they only go up from there. At the top peak, you can pay 62 cents a square foot. So imagine paying, that's almost a mortgage payment a month you have to pay for nothing really.
There are going to be, and there are, some sellers downtown that have to sell. And there'll be some foreclosures down there as well.
Mm-hmm.
But when you figure in the homeowners association fees and the fact that you don't have any control really, you're one voice in one building, and some of the homeowners association bylaws limit the number of tenants in a building. So that's another big factor that you want to look out for if you're thinking about downtown.
Now, I do have one client who is buying a short sale in one of the buildings downtown. We're almost under contract. A short sale, nothing short about a short sale. We're under contract, but it probably won't close for a couple of months. But it's going to be a great deal. It'll cash flow.
Yeah.
So if you're interested in the condo scene and you want to get into it, it may be a lifestyle choice. It doesn't necessarily have to be an investment, but we are looking for every investment out there.
And they're not building any more condo units downtown.
Yeah, there's no more buildings online. That's a good point. Great point, really.
So,
I mean, in the last month, they've been snatched up.
But in Austin in general is the same way. There are maybe 2 or 3 developments in Austin that are coming online or
right.
are online.
Right.
So, you know, homes are in the same situation. There's no new homes being built right now.
And no new real lot development either because of the lack of financing.
And that's definitely going to help our resale market come back in a big way.
There's no way for those developers to finance that property unless they've got cash.
Yep.
Okay, I think we have about time for one more question. Someone said, I do not know how to make repairs. Do you use a management company, and how much do they charge?
Well, a lot of times when we have an investment property and you get you under contract and we have the inspector go through, right behind that inspector we'll send our contractor and really bid out a lot of the work. And it's not an exact science by any means. It's a great guess at how much you're going to be doing. And if you factor it in properly, yeah, you don't have to do any of those repairs.
Absolutely not. In fact, I can make anything appear or disappear.
Yeah, don't give me a hammer.
It's all about, your checkbook, really, because we've got fabulous teams of people that can do everything from, sheetrock and framing to changing out carpet and paint, doing landscaping, and all of that is so competitive. We use these people over and over again. They give us fabulous prices. So.
And quick turnaround,
Yeah,
too. They'll pick our
absolutely.
project over others really quickly.
Exactly.
So if you're interested in a rehab and resale, we have the team of people, but
And
not
we've been
all
over.
investment properties are rehab and resale.
That's right. Some of them just need really minor stuff.
Definitely.
Just a little loving. Okay, well, thank y'all so much for coming to our webinar. We've had a great time with y'all tonight. And again, this will be replayed on our website at www.westaustin.com. And we look forward to seeing you at the next one. Thanks.
Thank you so much.
Thanks.